I was just going to say, what do you make of it all?
Yeah, look, I think it's been an interesting period. This week is exactly as you summarized. You know, towards the end of last week, we definitely had this theme of term premium resurgence. And then over the course of this week, some of that was unwound. We thought, oh, it's, you know, good times again for oil markets. But after last night's CPI print, it's everything off again, right? Risk off, bond off. Nobody wants to hold anything. But I do think that the dominant theme here is one of the market buying in more and more to this idea that the data in the US especially has surprised everyone this year. And as a result, soft landing is really starting to catch as consensus. This very belief that we will avoid recession somehow this time around. This time around, we can somehow, you know, land that very narrow part of the landing strip called soft landing and then take off again without even seeing recession. This belief is what's leading to this rise higher in long-end yields in particular, real yields in particular, and this tightens financial conditions. And, you know, I do think that the market needing to unwind its belief about recession is the very conditions that's needed to drive the markets to behave in such a way that will then plant the seeds of the next recession.
Okay, so there's that. I mean, I'm just wondering, you're saying the reason why we're seeing term premium turn positive, is that more about the U.S. economy and people thinking this is stronger than what we initially thought? Or is it really also the debt supply issues as well that is leading to this term premium to stay positive?
I actually think it's both. You know, in normal market times, if you'd have asked me, this concern about greater fiscal-induced supply of government bonds, is it going to lead to higher bond yields? I'd have said, well, no, there's generally not a very stable relationship between supply of treasuries by themselves and then where treasury yields go. Because if you think about it, normally governments go into a fiscal deficit because the economy is struggling. They're going into a deficit situation to be able to enact on fiscal stimulus that will counter recessionary forces. And when there are recessionary forces, the market finds all these haven buyers, and those haven buyers are more than enough to offset the increased supply in Treasury. So usually Treasury supply goes up when the economy is weak. The difference this time around is the economy is far from being weak, right? Growth is comfortably at, if not above trend, and has been surprising everyone to the upside. So haven buyers are just not really around. And then you add to that, you know, some of the currency instability you've been seeing in emerging markets of late, central banks that normally would have been building reserves and needing to shed reserves in order to defend their currency. So yeah, there definitely is a bit of a supply-demand imbalance at the moment. But I still think that at the heart of it, the strong growth story, the resilient economy story, is part of the reason why real yields are here, right? 10-year real yields, 30-year real yields, 2% or higher. How do you sustain that over the longer term?
Yeah, Amy, the thing is, you know, you always have this balance here for the price action and what you've got in terms of income. And, you know, how do you actually minimize the amount you sacrifice in terms of income when you look down the yield curve?
Yeah, so looking down the yield curve, looking down the yield curve, and also looking down the quality curve. Like this isn't the time to be making hero calls, and I think I've been saying that for a little while. But you know, this argument that I'm making, which is the market's very belief that we will avoid a recession, seals the fate of the next recession. It's important not to position for that too early, and especially for income strategies and the kinds of portfolios that I look after. You know, it can be quite painful turning too defensively in your portfolio too early as well. And it can be painful in two respects. You can turn too defensively by going too long into bonds before the bearish momentum has sorted itself out. As we just discussed now, this supply-demand imbalance in the bond markets needs to find a clearing level, right? And I don't think near term we've quite found that just yet. We're closer to the end than we are the beginning. But second of all, I think, you know, shying away from, you know, good quality credit that can provide you that extra level of carry on top of government bonds too early in the cycle just means that you miss out on too much of that income potential for your portfolio as well. But I do think that the stronger economy means we get another leg higher in risky assets, probably time to then shore in the portfolios a little bit more and lean into defensiveness in the first half of 2024.